And welcome to Retire with Clarity. My name is Cynthia DeFazio, and I'm joined today by Stewart Fields and Chris Massenburg of Open Air Advisors. Chris, how are you today?
I'm great. It's good to see you again.
It's good to see you, Chris. Stewart, how are you?
I'm doing great as well.
Good. It's such a pleasure to be back in the studio with you, because I know that you've both been so incredibly busy helping people plan properly for retirement. So Stewart, right out of the gate, how busy has it been for you in the office lately?
We're answering some of the same questions over and over right now. I mean, we look at what's kind of happened in the world. You know, things are getting a little bit more expensive when we go to the grocery store, if we go on a vacation. So what's that called, Chris?
Inflation.
Yes.
Yeah. So basically, yeah, we've been busy, a lot of different things, a lot of volatility in the market, a lot of geopolitical events going on, which is really impacting our clients. So just trying to take a more proactive approach, making sure our clients are taken care of. So, you know, if these events continue to happen, which we know they will, we just don't know what, that they're, you know, in a pretty confident spot that they feel pretty secure about.
Sure, that makes sense. Well, Chris, obviously Stewart just tapped in on inflation, and that's such a hot topic right now. So let's talk a little bit about that more in depth. How does the rising inflation rate actually impact a retiree?
Well, it can have a huge impact, obviously, on someone who's retired with a fixed income or on a fixed budget. Because as we all know, things don't get cheaper as we get older.
Right.
They get more expensive, and it's even more so accelerated in the time we're in. You know, a lot of it has to do with going back to supply chain issues from the start of the pandemic, where everything got log jammed in these supply chains coming into the country. That helped inflate prices, and then obviously supply and demand plays a big role in that as well. So less supply, high demand creates higher prices.
Sure.
And so we've seen pretty much across the board inflation at 40-year record highs going back to the 80s and late 70s. We haven't seen it this high since then. So it has a huge impact on a retiree, especially because you're budgeting for things to cost a certain amount of money over time, and you've worked that into a plan. So now people are really having to adjust and make sure they're still on the right track. So, you know, like Stewart talked about earlier, we've been pretty busy lately working with clients, both existing and new clients, who this is a huge concern for a lot of people going into retirement. So.
Absolutely. Stewart, how can you help retirees be comfortable with the rising inflation, if you will? Is there a way that you have guardrails on a retirement plan?
Yeah, I mean, I think really good communication helps. Basically, you know, looking at going back almost 2 years now, that's when the pandemic started. And so with that, as supply chains got, you know, hit, people were getting laid off, people weren't even allowed to go to work. So we saw a big lifestyle change. We saw a huge shift in workforce. So people were retiring earlier. And so what happens is it needs a lot of communication. Like, all right, this is the factors that we see. We're expecting inflation to go up, because really what's happening is at the same time, the government, to help people out, was printing a lot of money. They were doing PPP loans, enhanced unemployment benefits. So a lot of people who were stuck at home had a lot of money to spend, which is kind of weird to say. It's like, all right, I just lost my job, but a lot of people or you know, quit or got reduced hours, but I've got more money to spend. So what we saw was a lot of people pre-pandemic was spending these dollars on services, having a good time with family, friends, and during the pandemic, they started shifting their money to Amazon, purchases, products.
Yeah, that's true.
And so what happened is we had a lot of money chasing too few goods, which has kind of led us to the inflation. So track that we're on. So as we're looking at clients and making sure that they're comfortable, we know that, you know, really, if inflation is 7–8%, your expenses double, you know, almost 8–9 years. I mean, that's a lot. So we have to put some guardrails in place to make sure that they can keep up with inflation or even outpace inflation. So what you did 10 years ago, 20 years ago, even 2.5 years ago is completely different approach needed today than basically what you did yesterday. So I think we've done, as a firm, a really good job at putting those guardrails in place, helping them basically address if inflation continues, because here's the bad news, I think, is inflation isn't going to go away anytime soon. You know, these things, even with the Fed, you know, trying to raise rates to combat higher inflation, these things take time. So we really need a plan to combat higher inflation for at least the next, you know, handful of years plus.
Yeah, and to that point, you know, just to add to that, How often do we see companies raise prices on their services or goods, and then when things get more stable, they decide, you know what, we're charging too much. The consumer's used to that higher price. Let's go back down to the old one.
Yeah.
Right. So we need to adjust for that as well. Once these prices have gone up and that cost has been passed on to the consumer, it's very unlikely that that cost is going to return to previous balance. So you got to plan for that as well. Things cost more as we get older, and they're going to stay there. So.
Sure, absolutely. What happens if someone does not have a plan in place for inflation specifically? Because I know that we've talked about this in the past, and obviously you have a well-designed holistic plan that covers everything. But what if someone is not factoring in the fact that things are going to be twice as expensive, Chris, down the road in their retirement years?
Yeah, I think that's a major risk if you don't. It's definitely can be a huge detriment if you don't plan for inflation. I know plans that we put together for folks all day long. We've always had assumptions of inflation in these plans. We can go back and we can adjust that rate for a higher inflation number. We can go back to a lower inflation number and kind of play with those variables as we put these plans together. And I think that's so important for folks out there who want to work with someone, whether it's a planner or maybe you just have a broker dealer you work with. Get these plans and make sure that inflation factor is calculated in there, because if you're not keeping up with inflation, then you're literally losing money every day on your cash.
Yeah.
Your dollar is worth less purchasing power every day. So.
Yeah, we definitely want to stress test the portfolios right now. You know, right now when you build plans, I mean, some of the clients we work with are, 5+, almost 10 years. And so inflation was historical lows when we first worked together.
Right.
So a lot of times we have to revisit, we have to monitor their plan and say, all right, this initial assumption was at 3%, but now let's look at the plan at 7% and see how that's impacting. So it impacts clients a little bit differently. Some are rurally impacted, and some are a little bit differently because they've saved very well and they lived way below their means, so they have a little bit bigger cushion than some people. So we kind of specialize in looking at their particular income needs, looking at the overall economic conditions, and say, hey, all right, what do we need to put in place to combat this, to make sure if they're spending $5,000 a month right now, we know 8-9 years from now it's going to be $10,000 and potentially $15,000, $20,000 20 years down the road. Right. So you're going to have to put a lot of things in place to make sure that we're combating it, we're keeping up, or outpacing inflation.
Yeah, and also with the pandemic, to his point earlier, with it being shut down, folks having this pent-up demand, some people's spending habits went in the wrong direction on certain categories. And so it's a good time to reel all that back in and really readdress what you're spending, where that money's going. And if you need to adjust in certain categories, like Amazon, for example, Target shopping, if you want to dial that down. Yeah. Not talking to my wife in particular. Yeah. But if you want to dial those categories back down, it's a great time to look into that, because maybe you were very comfortable buying things before at a certain price you had in your head, but now, without even realizing it, those things cost so much more, and maybe they really shouldn't be in that budget. So that's something to reevaluate ongoing.
Sure, that makes perfect sense. Well, Stewart, I know that you and Chris have a very special offer to present to the viewers at home today. Let's talk about what that is before we open the phone lines. Absolutely.
Yeah, if you've ever had questions about inflation or how this will impact you, or if you're concerned that a lemon costs $1.40 now when it costs 25 cents just a year ago, please give us a call. Let's see basically how this will impact your plan, not only now, but 5-10 years down the road. There are things that we can do to put in place to combat inflation, but I think the first thing and the first step in this process is finding out how sensitive to rising inflation your portfolio is. So for the first 10 people who call in today, you're eligible for our Clearpath retirement guide. This is a very extensive report that goes into much more than just inflation, taxes, inflation, withdrawal rates, and your risk. So give us a call, 844-333-6059.
Stewart, thank you so much. Chris, thank you so much. To the viewers at home, the phone number to call is on your screen, and that number is 844-333-6059. We know you have a lot of questions about how to plan your perfect retirement. Stewart and Chris have the answers for you. Again, that number to call is 844-333-6059. We're going to take a very short commercial break, but when we come back, we're going to talk a little bit about bonds and how they can kind of deviate a little bit with the rising interest rates. Stay tuned.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
And welcome back to Retire with Clarity. My name is Cynthia DeFazio, and I'm joined today by Stewart Fields and Chris Massenburg of Open Air Advisors. Gentlemen, a wonderful show that we're having today, talking about the importance of planning properly for retirement, specifically in regards to inflation. I want to talk a little bit in this segment about bonds and how they correlate with rising interest rates. Chris, let me start with you. What happens to a bond portfolio when interest rates go up?
Yeah, so traditionally, as interest rates rise, the value of those bonds will go the opposite direction. They'll decline. It's very simple. If I can go out on the open market and get a higher interest rate for that same bond, then I'm going to pay less on the secondary market for the same bond that you have. So that interest rate that might be a little bit lower than what's out there is worth less money on the open market. So that's very directly how they're correlated. And typically when we build portfolios, we have equities and bonds to offset some of that risk. But as we know, with rising interest rates, those bond portfolios potentially could suffer as rates come up and the value of those decline. So some of those older methods out there might not be as valuable going forward. And so we want to try and plan for ways around that. And so Stewart has some ideas he likes to share with clients on that.
Okay.
Yeah, so really when you start looking at the old way to do it, you referred to it, and how I like to kind of coin that is it's the 60-40 approach. And for those who don't know what that means 60% of your money goes in equities and 40% of your money goes into bonds. And like you guys were just stating, is when interest rates go up, bonds will go down. So being fiduciaries for our clients, it's really hard to say, hey, we should go put a large volume of money into, $300,000, $400,000, $500,000 into bonds. That could face downward pressure as the Fed raises rates or the macro interest level increases. So a lot of people say, hey, well, what should I do with my money instead? So there's different ways that we could park money to basically say, hey, let's keep up with inflation, like we were just talking about, but also basically allow us to grow our portfolio so we have that confident, secure retirement that we're all looking for. So one way, people say, well, how do I do it? I don't want to go to equities because that's way too risky. The market has come down, but we're still really close to all-time highs in the grand scheme of things. So cash isn't really making any returns right now. So there's one idea I like to kind of throw out there as a bond alternative. So really, instead of putting 60% equities, if I can show you this graph really quick, I think it'll really resonate to a lot of our viewers tonight, is that if you look at the big portion of stocks. So to keep things simple today, let's just leave that alone. This 60% will go into stocks. Basically, the other 20% could go into more a traditional type bond portfolio, maybe using, floating rates, things that will adjust as interest rates continue to go up. But maybe carve out, instead of basically putting all your money into traditional bonds that could face downward pressure, is we can use basically something that's called a buffered ETF or a defined outcome ETF. And how these actually work is, instead of basically being interest rate sensitive, there's a buffer level, and really that buffer level is about 30%. You do not participate in the first 30% of the market losses. But that sounds too good to be true, so what is the catch? Well, the catch is the flip side. The ETF is going to cap you out at about 9, 10, 11%, just depending on how we build this for you. So instead of putting, $300,000, $400,000 in a bond portfolio, you can actually make 4, 5, 6% rate of return in this rising interest rate environment right now. So there's many different ways that we could park this bond money. A lot of people ask about annuities, fixed index annuities. Do these fit in the portfolio? Potentially. Potentially this could be a good bond alternative. Let's park our money into a vehicle that can get us maybe a safe 4 or 5% rate of return as the interest rate environment normalizes. And once it normalizes, we can get out of these, more these assets and kind of go back into that more traditional approach if rates really get back to what they were, a decade ago.
Yeah, absolutely. And we have to be a little more creative these days. By all means, if we could get a traditional CD that paid us 5% interest, we would certainly look at that. Those rates are just not available out there. So you have to get a little bit more creative when building these plans. Some of these alternative options, like Stewart was talking about, the annuities or the buffered ETFs can be great options for some folks. And to that point, you're just trying to really try and keep up with inflation. And you can't do that sitting in cash, and you can't do that sitting in traditional CDs because that interest is just not out there. So these can be great alternatives where you can have some sort of principal protection where you don't have to be all stocks and you don't have to worry about interest rates really impacting that bucket of money as well.
That makes perfect sense. Stewart, I should ask you, you obviously mentioned the fixed indexed annuities. Can we talk a little bit about what the different types of annuities are in case people in the viewing audience are wondering if there's more than one type?
Yeah, absolutely. So most people that we come in, I'd say at least 70% of the time, they already have some sort of annuity. And so there's 4 types of annuities. The first one that was really invented was called the SPIA, a single premium immediate annuity. I kind of call that the grandma's annuity. You get income right when you give the insurance company money, but when you pass away, the income stops. So there's not a big reason for those anymore. Like anything else, products have developed. So the second one that really kind of came along was the fixed annuity, kind of like a CD, but maybe a little bit better rates because the terms are a little bit longer. The third one would be variable annuities, and I think it's this annuity that's really kind of given it a negative connotation because variable annuities are famous for fees, 3, 4, sometimes 4.5% instead of a variable annuity.
Yeah, I had somebody in my office last week, 3.65% in fees every single year, just on that account, just to own it. And they didn't have no idea. So.
And they probably have a lot of hard time getting out of them. So again, variable annuities can be, there's a surrender period involved. And then basically the fourth one is a fixed index annuity, which, is relatively new compared to the first 3. And really these are designed how we use them. I mean, there's hundreds of different vehicles out there. I don't really think that they're long-term solutions because, well, annuity, don't I have to own that forever? Not if you get the right ones. So we want ones that are kind of designed for withdrawals, that are built for protection. Because again, inside of a fixed index annuity, how they work, one of the best parts about it is it's 100% protected from market losses, which is really important because if you think about it, one, if the market goes down, your expenses don't go away. So you have to have a place to go for to live off of. So you don't want to go sell something at a loss. So it's nice to go to that fixed index annuity and say, hey, I didn't lose money here. I can let my rest of the account recover. Or another way is to basically use a term called dollar cost averaging. You can take some money out of the annuity and go buy stuff when it's low. Because when the market's down, do you want to be buying or do you want to be selling?
Great point.
Yeah, you want to be buying. So, but if all your portfolio is down, you have nothing to buy with. So we can take money out of here and go dollar cost average when the market's on sale. So again, if you leverage them properly, it's not something that you have to have for a long, long time. In fact, most of the ones that we use have 0 fees on them as well. So it's a really good tool to combat interest rates, bonds not being the best investment right now, to really kind of substitute some safety and give you that 4 or 5% return that you're usually looking for from a bond portfolio to begin with.
Okay, and as you mentioned, just the perfect time to reevaluate what's in the portfolio to make sure that it's the right plan for you going into retirement. Correct?
Absolutely. So if that's you and you're looking to get this plan put together, or maybe you want to evaluate the plan you already have right now, we're offering for the first 10 callers what we call our Clearpath retirement plan. And this plan obviously will look at everything you have in place, do a double check, look and make sure it's still right for your situation. And then if you have an annuity, we can evaluate that as well. I would say most people who come in think they have a fixed index annuity when it turns out they have a variable annuity, and those are much different. They can be high fees, and you assume all the market risk when it goes up and down. Okay, so we can do these plans for you. There's no cost. Call us right now, 844-333-6059.
Chris, thank you so much. Stewart, thank you so much. To the viewers at home, the phone number to call is on your screen. That number is 844-333-6059. Any questions that you may have about how to plan your perfect retirement, Stewart and Chris have the answers for you. All you have to do is take advantage of calling in today. That number is 844-333-6059. We're going to take a very short commercial break, but don't go anywhere. I have so much more with Stewart and Chris when we return.
At Open Air Advisors, we are passionate about making sure our clients live stress-free in retirement. When meeting with new clients, our biggest fear is whether it's too late to fix other advisors' mistakes. When you're nearing retirement, it's essential that you have a written plan and know exactly how that plan will work for you in retirement. Many consumers place loyalty to their current advisors over the retirement success. Always get a second opinion. For a complimentary review, contact us today.
We are frequently asked where we think tax rates are headed. Most experts agree tax rates will eventually have to go up as our federal debt increases. Without any changes, the government's current plan is set to expire in 2025. Every penny counts, especially in retirement. Is your current plan efficient and optimized to reduce your tax obligations? Contact us today at Open Air Advisors for a complimentary review.
And welcome back to Retire with Clarity. My name is Cynthia DeFazio, and I'm joined today by Stewart Fields and Chris Massenburg of Open Air Advisors. Gentlemen, a wonderful show we're having, talking about the importance of planning for retirement, especially talking about inflation and taxes. So in this segment, I'd love to talk about some strategies for the stock market, if you will, because obviously we've been enjoying such a healthy run for a while now. But Stewart, what happens when it starts to correct?
Yeah, and so really we were talking about the first, half of the show talking about bonds and inflation and what to do. But history says the number one way to beat inflation is with equities and with stocks. So, and this is still truer now than ever. And so really the idea is people say, well, the market's at all-time highs. How do I protect my money? The last 10 years have been really good for the market. So how do I cash out some of my chips? How do I lock in some of these gains? But also still grow the portfolio in case the market continues to go up and up and up. Because we're not market timers, there's no crystal ball. I know there's a lot of things going on, in the country, around the world right now that we think, oh, the market's got to go down, and it might. But a lot of times we've been wrong before, and basically our gut was wrong, and the market kind of does a about face and starts going up. So when it comes to stock selection, we really have to have a much narrower focus than we used to, going back to the old ways. I get a lot of portfolios that come in, very famous guy, so I think I could say his name, the couch potato, Scott Burns style, kind of set it and forget it. Okay. And that usually worked, 10, 20, 30 years ago when you could basically just buy just a little bit of everything, and your returns did quite well during that period of time. But when we look at where the returns come from, for a fun fact, 2021, last year, the S&P 500 did about 27%. But if I took someone off the street and said, what was your portfolio return last year? They're not anywhere close to 27%. And usually it's because they're over-diversified. They basically own a little bit of everything. And so when you do research about where the growth comes from in the market, 75% of the returns have come from the top 16% of companies.
Really?
So you have to take a little bit more focused approach, a little bit more of a narrower approach now than ever. Because again, the top companies are leading the S&P 500. They're consisting of a lot of that 27%. So if you own a little bit of everything, your whole portfolio is kind of doing everything, too much of that portfolio is being dragged down by underperforming stocks. So we want to make sure whatever risk you take, whether you want to take a little risk, no risk, or a lot of risk, whatever risk you decide to take, you need to get rewarded for the risk that you take. So that's something that we look at. How efficient is your portfolio? That's going to be really key going forward with the volatility that we're seeing inside the markets.
Absolutely. Chris, I should ask you, how has the pandemic caused innovation at faster rates than ever for some companies? Why the pandemic?
Well, it's a great question. Innovation is accelerated because of the pandemic, because we were all forced, worldwide, essentially, to work from home, and these technologies were pushed into the forefront because we couldn't all get together in traditional office buildings and work anymore. So we had to push forward a lot of this technology to figure out how to work remotely, how to keep supply chains intact autonomously in some cases, right? So a lot of that's pushed forward, and so some of the great statistics, and Stewart likes to share this one a lot. It's one of my favorites. The indoor plumbing toilet took 90 years to adapt across the country. The cell phone took 15 years to fully adapt, and the smartphone only took 8 years to adapt across the country. So innovation is accelerating, happening faster than ever. And so those companies, a lot of companies too, are having a shorter lifespan as far as technology goes, having a shorter lifespan than ever. So some of those startups flare up real quick and then burn out just as quickly. So innovation is big key part of growth, because if you're not innovating, you're on the way out. Right?
Sure.
And that's why it's so important to review, monitor your portfolio, because what I was saying is it's so top heavy right now, but because of innovation, the companies are coming in and out of that top 16%. So again, if you're kind of just setting it and forget it, if you look at the Peloton, the Peloton was the hottest thing that we talked about during the pandemic. And now, they're struggling. And so the idea is, because of innovation, because of lifestyle changes, you just never know basically what comes and goes. So here at Open Air, we use institutional caliber managers who are continuously looking, exploring different parts of the world, the country, to really make sure that we're participating in the areas of the economy that are poised to grow for your growth portion of your assets. So that's going to be really important to make sure that your portfolio can adapt, it can change with time. Otherwise, what you'll see basically the markets grow and you look at your portfolio and kind of scratch your head and say, why didn't I get that return? And a lot of times it's just the approach that you're taking, it's just a little bit old.
Sure. And Chris, I love how you say best advice is conflict-free. Can we talk about what that is?
Sure, absolutely. So at Open Air, we're all fiduciary advisors. We like to say, we don't care which tool you use to get the job done, as long as it's the right tool, right? Not everything is a hammer and a nail. So all of the advice that we give is on that fiduciary level. It's in the best interest of the clients, and it's goal-oriented. So what's the goal? Then we figure out what the tool is that we need to use to accomplish that goal. So we're very proud, like I said, to say that we're all fiduciary advisors at the firm.
Which is so important, absolutely. And Stewart, I know that you and John actually have a special offer to present, or Chris, I'm sorry, to the viewers at home today. Let's talk a little bit about what that is before we close and say goodbye to the viewers.
Yeah, for the first 10 callers who call us tonight, we'll take you through our Clearpath retirement guide. This is a very deep dive into your plan. We talked about inflation, interest rates, a top-heavy approach. We need to look at your portfolio. The market's near all-time highs, is to make sure if we do see a crash, how affected is your portfolio? Can you make it? Do you need to make changes? So for the first 10 callers who call us today, I encourage you to pick up the phone right now. Call 844-333-6059 and let us take you down a clear path to retirement.
Chris, thank you so much for an amazing show. Stewart, thank you so much for an amazing show. To the viewers at home, most specifically, thank you for spending time with us today. That number to call is 844-333-6059. Any questions for Open Air advisors, these gentlemen have the answers for you. Again, don't miss the opportunity to call in, 844-333-6059. We hope to see you back here next week. Thank you for watching. Be safe, be happy, be blessed, and please keep the viewer questions coming. We may have an episode devoted just to you. Thank you for watching.